Hi, everyone. This is Jason Burek of Wall Street for Main Street.
And Lee Justo from Risk.
Welcome back for another episode of Finance Unspun. This is episode number 4. We're recording this show on Friday, June 17th, 2022. Lee, there's so much craziness going on right now. So many things that we can discuss. We could talk about Japan. We could talk about these fires that seem just weird for giant Russian oil fields, giant Russian natural gas fields, all these crazy. And then
there's been fires for food producers here. I think over 100 of them.
And then also the liquefied natural gas export facility, which is going to reduce natural gas demand temporarily, but it's going to really squeeze European supply for natural gas because they were counting on those liquefied natural gas exports.
Hey, if you were living in Europe right now, would you be looking at a wood stove?
I don't know what advice to give them at this point. I don't know. I'm glad my energy bills are not going up at United Kingdom or European Union levels. Although, unfortunately, I think here in the United States, that's probably the next shoe to drop is at our electricity bills because of how much natural gas prices are up in the last 2.5 years here in the United States. I think the electricity bills are going to be up enormously. We may have a doubling of natural gas bills in the next 12 to 18 months. I think it's going to get ugly.
It's very disconcerting, especially if you're a homeowner.
Well, and this is going to kill the U.S. consumer even more. This is going to kill discretionary income for the U.S. consumer even more. So the R word, which the PhD economists in New York City, on Wall Street, and at think tanks and economic consulting firms, the R word is recession. For those of our listeners who aren't familiar with that, the U.S. government, the U.S. federal government, the people at the Federal Reserve Bank, the PhD economists who are wrong on all of their predictions, who are wrong on all of their economic propaganda.
Yeah, of course.
They don't like the R word.
Let me ask you a question. If you were the CEO of, say, Walmart or Best Buy, and you're sitting on the inventory, people aren't buying, what are you going to be doing for the holiday season? You're going to be just trying to sell what you got?
Well, ideally, you want to get cash immediately. I mean, in an inflationary environment, you want the cash first, and then you want to figure out what to do with it. But we'll see if they decide to do that. I mean, some of them may hang on to the inventory and try to sell it around Christmas and hope that people have some money saved up and try to have some decent Christmas sales. But we'll see. We'll see. I would say at least 6 to 8 weeks before Christmas, how big a sales. So if you start to see like unbelievable discounts compared to the past, so like the companies that have the 2 companies that have disclosed the largest amount of inventory so far that they have excess supply of inventory are Walmart and Target. Mm-hmm. I haven't really heard if any of the other larger retailers have that type of excess inventory yet. I imagine.
I do know that Samsung actually told some of its suppliers to delay shipments to them. And also, I don't know if you saw Revlon filed Chapter 11 this week. A lot of stuff going on. And Tesla is actually hiking the price of their vehicles, some $6,000 per vehicle. So a lot of changes in the retail space.
I'm not surprised Tesla's hiking prices. I mean, all the costs to make, whether it's a regular car, steel, all the copper, all the things, that electronics, the lack of chip shortage, all those things that go into a regular car. There's tons of computerized and automated things that go into these cars now. An electric vehicle is going to have a lot of that too. Electric vehicle is going to have even more copper. The price of copper has come down substantially, but I mean, overall, still over the last couple of years, copper is going to be in a long-term bull market. There's a lot of research out there from well-respected commodities research firms that the next 10 years, there's going to be a really big copper shortage because a lot of these major copper mines that have been producing for decades, they're depleting very, very rapidly. And even though the copper price got to, I think, almost $5 a pound about in the last 4 to 6 months, a lot of new copper mines did not come online. So the copper mines that were producing benefited. But this is the problem with the supply side and investing with mining companies, oil and natural gas, agriculture. It takes years for the supply side, and you have to make many billions. A copper mine, Lee, could run you, some of these copper mines, a tiny copper mine, Lee, is hundreds of millions of dollars. A medium-sized copper mine is well over $1 billion. If you're talking about a giant copper mine, you're looking at over $5 billion and potentially many, many years of construction, permitting, all these things just to bring the new supply online.
You know, I had interviewed David Smith about 7 months ago on my channel, and it was all about copper and how we were going to enter a huge bull cycle with it. So I am not surprised by hearing any of this.
So in the short term, copper may correct because a lot of it's probably dependent on the housing market and electric vehicle sales. So there may be a buying opportunity along with some of these really quality fertilizer companies, really quality natural gas companies, liquefied natural gas exporting companies, oil companies. Some of the oil companies went on sale recently this week. We had a big disparity. I actually wanted to talk about that. That was one of the first topics I wanted to talk about in our show notes here. So the oil price itself is not down. So the West Texas Intermediate or Brent crude oil price, this show is on Friday, June 17th. We're back down, I think, under $110 a barrel West Texas Intermediate. Brent crude still around $113 a barrel when we're recording this show. So it's only down around 2% compared to what it was, I think, earlier this week. So it's not an enormous drop. But
the oil company stocks are not down, correct?
Yes. Well, the oil company stocks, some of them are down 12%.
Not as much.
Well, some of them are down 12%, 15%, even 20%. And we're going to discuss a little bit why and maybe how over the next couple months, maybe 4 to 6 months, there could be enormous buying opportunities for some of these quality companies because I do not see the food and energy crisis going away. Now, if we do have a crash, that could temporarily knock the prices down, but it would be similar, I think, to the first and second quarters of 2020, where if you had a couple year horizon, you could get another big pop if there is that type of crash. I mean, you don't talk about anything guaranteed anymore because there's so many rules changes. I mean, now we've had negative oil. We had negative oil prices on the futures for a week.
Do you remember that?
Well, I never thought I'd see that in my lifetime.
I think this is a good time to mention just time frames because we've had a tremendous down move in the markets. Crypto's been slammed like crazy. But me looking at things right now, it looks like we're about to bounce. And that's just a corrective move, though. That's short covering, etc. So when you're listening to information like this, you always have to keep the time frame in context.
The other mistake that people make, too, is they go out and they read an article about a company and they buy all their stock position at once, which is something a amateur novice, a beginner, a retail investor would tend to do. You do not buy all of your stock position at once. So if you do research on a company and you're looking at a 2, 3, 4, or 5 year time frame and you're looking to make either double on the shares or more. Well, in the case of Chevron, best with these things is like a case study with like Chevron. When I was writing about Chevron, how cheap it was in the first and second quarter of 2020 for patrons. I think it was around like $65 a share. There was a lot of people that were saying that Chevron was too risky, even though they were a low cost producer. They had the least amount of debt on their balance sheet of any of the larger oil and natural gas producers that were publicly traded. So they had a solid balance sheet relative to the other companies. They were a low cost producer. And I was just looking and seeing all this natural gas supply coming offline. The oil supply was obviously coming offline. And I was more bullish on natural gas because I was reading through the investors' presentations and the annual reports of these companies. And I was like 2 or 3 years from now, if natural gas goes to where I think it does, Chevron's just going to mint money. But expecting like a 5-10 times return on your shares, though, for a large company already like Chevron is
very difficult to do.
Well, they're already big. So like a 2 or 3x move for a company like that, where the market cap maybe goes from 250 billion or 300 billion to 500 billion or something.
It's not like you're buying Amazon in 1998.
Correct.
Yeah.
And it's not like you're buying a company with $1 billion market cap and then they come out with a new product or service and then it goes to a $10 billion market cap or a $50 billion market cap. So the company's already large. So you have to have more realistic expectations. They're also not creating a new market like Apple Computer was when they created iTunes and all the App Store and all the different Apple products with the iPod and the iPhone and the iPad, all these different, they created an entire ecosystem where they were on the brink of bankruptcy, and then Steve Jobs came back and then he just reformed the company amazingly.
Well, it's basically investing in a blue chip company is what you're doing, and not a high growth stock. It's just a completely different type of investment.
Well, you can still get dividend growth, and that's one of the ways. That's one of the ways to offset stagflation, to offset inflation. to beat it is you have to figure out how to grow your income in different ways. And it's not going to be one way. You're not going to be able to grow your income just one way normally, unless you're a really smart entrepreneur, you're working really hard with your friends and family, maybe after your day job, and you've figured something out really well online or in person, a new type of business or service, and you could substantially grow your income. Most people are not like that. The amount of work also to learn a new skill, create a business, study the knowledge to grow a side hustle like that is enormous. So the average person there, if you're going to grow your income, one of the easiest ways is to figure out dividend stock growth. Unfortunately, governments can change the rules. They can increase taxes with oil and natural gas companies. They can put windfall profits taxes. But this is why, Lee, you can't put all your eggs in one basket, though. And you kind of have to have like an anti-fragile approach to beat stagflate tax lie, to maintain your standard of living, to grow your income. You have to say, well, what are the different ways for me to grow my income so I can maintain my standard of living? And dividend growth is one of those. So these consumer companies, these consumer discretionary companies, they're getting hit hard. While a lot of these commodity companies at the certain commodity prices, yeah, their costs are up substantially, but the commodity prices are still relatively high. Some of these companies, unless all these politicians just put insane amounts of windfall profits taxes, and I don't think a lot of these windfall profits taxes are guaranteed.
I think there's a lot of political risk. I think the political risk in this in the world is growing every year, but you still have to invest and find ways to make money in that context. Which brings us to David Einhorn. What do you think about his investment strategy and his recent comments?
So I've read a lot of value investor books. I've read Benjamin Graham, Intelligent Investor. I've read a lot of them. I've even read a good amount of the Margin of Safety by Seth Klarman. Those books, Benjamin Graham's Intelligent Investor, and then you have his textbook, Securities Analysis, which I haven't read. That thing's incredibly thick.
Yes, then, I have a copy. I've not read it myself.
And then you also have Margin of Safety by Seth Klarman. Now, that book, you can't go to a bookstore to buy it. You can't buy it on Amazon unless you want to pay hundreds of dollars for a used copy. It's been out of print for over 20 years, I believe, but I think you can get a free PDF copy, an ebook of the book. That's how I got it. I think it was on Value Walk. On the main value investing websites, you can go and buy it. And I'm doing a roundabout way here because David Einhorn is one of the top dogs. I respect him a lot. He's an amazing hedge fund manager. People criticize him heavily, but if you look at his returns, he produces unbelievable returns almost every year, 10, 15, 20% returns, very steady. He can figure out how the markets are changing. He adapts pretty well. And David Einhorn, I would consider him a classic value investor. In the past, he normally would not buy oil and natural gas stocks. He would normally not buy mining stocks. Why? And this brings me back to my point about the value investor books. So in an entire chapter for Seth Klarman's Margin of Safety, he basically goes through the commodities businesses, the mining businesses, and why, as a classic value investor, reading one of the value investor Bible books or the holy books, there's like a holy trinity or something like that of value investor books. There's at least 3 or 4 main books. And he goes through an entire chapter why, as a value investor, you should never buy mining stocks. You should never buy oil and natural gas stocks because you cannot predict commodity prices. And because the businesses are that difficult, the costs, the profit margins, the costs are very difficult to predict. The costs can rise a lot. And the profit margins, they're either tiny or they can disappear very, very quickly. Mm-hmm. And we just, David Einhorn, for our listeners out there, I posted it on the Wall Street for Main Street community page on YouTube there. He just released on his Twitter, and he never tweets, but he just released it. He did an investors presentation for the prestigious Sohn conference. He did it online. So he had like these slides prepared, and he goes through like all the global macro reasons why the US Treasury, US federal government, why things are going to get pretty ugly with US federal government finances in the next 2 or 3 years because of the R word, and because the U.S. economy is basically built on consumer spending and also cheap energy. Our infrastructure is that bad. The U.S. economy, more than any other economy, our infrastructure is rated grade D and F now by most major infrastructure rating services, that we have to have cheap energy. So he outlines the case where there's going to be enormous supply side problems. And he disclosed just a long list. And this was pretty shocking to me because he's a traditional value investor. And he disclosed these positions in base metal mining stocks. He disclosed positions in oil pipeline companies. He disclosed positions in oil and natural gas producers. So this was pretty shocking to me. And he joins the list now of very, very smart investors, Lee, who are accumulating large positions in oil and natural gas and base metal mining plays like Stanley Druckenmiller, Warren Buffett, and now David Einhorn. And these are people that in the past would not normally accumulate that, some of them not at all.
Well, Ray Dalio came out and was bullish on gold, and CNBC brutalized him over it. So,
well, you can't. So, I actually used to speak in emails with Michelle Caruso Cabrera when she was on CNBC. Actually, she told me I would have been allowed to go on TV, but I couldn't say anything about gold price manipulation. So I was like, well, why do I want to waste hours a day getting ready for an interview that's like 2 minutes long when I can't talk about going on gold price manipulation? And she was like, no. She was like, if you want to start building a brand or something like that and coming on media, you can't talk about this stuff. The sponsors don't want it.
Yeah.
And that's why Peter Schiff's not allowed back on. Well, and then Pinto got in a fight years ago with Aaron Burnett, but I think a lot of it was over talking about gold and silver. Yes.
I agree. And Pinto is such a great guy. He absolute gem of a man and very smart. So anyway.
Oh yeah, I've interviewed Michael Pinto quite a few times. He's a brilliant mind.
Absolutely, and he's a gracious guest. So
one of the most underrated Austrian school economists out there too.
Oh, absolutely. You know, one statistic that really stood out to me, the Dow has actually been down 11 of the last 12 weeks. And this actually beats the Dow in 1929. So this has actually never happened before. Setting up for an interesting 2022.
Well, another thing is people criticize gold prices all the time. But if you look at gold, it's relatively stable. Paper gold prices in US dollars, we're still at $1,839. So we should be, in my opinion, well over $2,000 an ounce now. But
and in the context of the market moves recently, while gold and silver are down, they're really not down that much.
And gold miners at these prices, unless the gold miner is super high cost, if they're a low cost gold miner or in the medium range for production cost for gold mine, they're still making really good profit margins. It's the high cost gold miners that are in trouble. But we're going to see a lot of mergers and acquisitions, I think, in the royalty space. So the larger royalty companies are flush with cash. They still have amazing profit margins and free cash flow. They're going to be looking to add growth to their pipeline. And then the low-cost gold miners, we've already seen a couple acquisitions. I was writing about these companies because they had really good assets. They were undervalued. And this gold miner was actually one of the lowest-cost gold miners in the world. So they were targeted. I think we're going to see the lowest-cost gold miners targeted, the medium-sized ones, for mergers and acquisitions in the next 6, 12, 18 months. It might even happen sooner than that. I mean, I've been hearing rumors from some of my mining contacts that there's a lot of offers on the table for mergers and acquisitions in the next 6 to 12 months. So gold prices are doing, on a relative basis to silver, gold prices are doing very, very well. The silver price, Lee, is concerning, though, because a lot of these silver miners, they had to buy gold mines and they bought high-cost gold mines. And the silver price is not at a good profit margin relative to the gold price, where the gold miners, a lot of these guys can still make a pretty good profit margin unless gold prices do come down and energy costs. So your electricity costs, because miners use a ton of electricity for crushing, milling, separation.
Yes. Yep.
There's a ton of electricity used. If they're really far out in the middle of nowhere with very limited infrastructure, they're using a ton of diesel for diesel generators. Yep. And then if they're a large open pit mine, they're using a ton of diesel for those giant earth mover trucks that are moving these enormous amounts of rock that's basically uneconomic ore, and they're putting it on the conveyor belt at the crusher, and then they're grinding this uneconomic rock down to small amounts for tiny grams per ton, 1-2 grams per ton gold for a lot of these open pit mines. Some of them are even lower than 1 gram per ton gold. That's how
it's a very, very difficult business.
It is in my opinion, Lee, mining is the most difficult business because they do not, the only thing the miners can really control, and a lot of these mining companies are not even good at that, is their costs. They have no control over what the commodity prices can do. They have, if they make a large investment in a country and all of a sudden the government, the politicians, the bureaucrats, the regulators change the rules or put a new royalty tax on a mine, the mining company either has to wait it out. They have to pay enormous amounts of bribes. That we're not supposed to talk about that publicly, but it does happen.
Speaking of mines and gold, Michael Saylor tweeted out, I think it was today, Uganda was claiming to have 12.8 trillion in gold in the ground.
Oh.
And I'm thinking, like, why is Michael Saylor doing this? There were rumors that his company is facing margin calls. Crypto's down like crazy.
That's like saying if we mine an asteroid, there's $1 quadrillion, over $1 trillion. There's trillions of platinum and palladium and gold on these asteroids, and in the next 10 years we're going to mine these asteroids, and the robots are gonna kill us all in the next 5 years. The robots are going to enslave us all. It's going to be worse than Terminator.
I mean, that was like the ultimate to me of Michael Saylor. I think he's, well, anyway, we'll leave it at that.
we may have asteroid mining at one point, but it is many, many decades away. So
if not centuries.
So the people who are citing that, there's plenty of platinum and palladium and gold on an asteroid. Good luck getting that.
Exactly.
We're going to be taking this stuff either off the seabed floor if the environmentalists ever approve it, or we're going to be, what's the right word here? We're going to be evaporating seawater, because supposedly there's a technique there at a certain gold or silver price. It actually becomes economic to start pulling little tiny granules of gold out of seawater.
Wow.
So that
price of gold would have to be pretty high. And I have this image in my head now of transporting gold off an asteroid in some spaceship, because gold is not light. I mean, this is heavy stuff. And then bringing it back into the atmosphere.
Gold is very dense.
Yeah, absolutely.
A gold coin's very heavy.
Yep. It's actually surprising when you put one in your hand for the first time.
Yeah, it's amazing. Gold and silver are amazing. They're beautiful to look at. I mean, the average person who is not familiar with gold or silver doesn't appreciate it. We did want to cover, we're almost at 25 minutes, Lee, so we wanted to cover one more topic here in this week's show. We wanted to talk about, besides the disparity in oil and gas stocks, and how, like, smart money that normally doesn't buy mining stocks, that normally doesn't buy oil and natural gas stocks. We also wanted to talk about Japan before we wrap up this week's show.
Sure. Basically, rumor on the street is that they were trying to break the Bank of Japan, some speculators like Soros did to the Bank of England, but it seems to have failed. And I think you have some insight as to why it may have failed.
So the Japanese yen is around a 24 or 25 year high against the dollar, low against the US dollar. Now, this trade, it's been called the Widowmaker trade for the last 15 plus years for hedge fund managers. I mean, I've interviewed people in the past that put this trade on 10 years ago, and they laid out all the case for why the Japanese economy, all the problems it was going to have. The Bank of Japan was in trouble. A 1% increase in interest rates was going to bankrupt the Bank of Japan. It didn't happen.
No.
The reason, though, that I think it happened now, one of the major reasons, is because of the way the Japanese economy is set up. And then also because of their largest holdings, the Bank of Japan, their central bank, and a lot of Japanese pension funds and Japanese banks, they own a lot of US treasuries. And then here you have, and this is what I've been talking about now for months, in a Federal Reserve Bank interest rate hiking cycle environment. If you go back and look in a post-2008 world, when the Fed starts hiking interest rates, they start breaking a lot of things. And
Absolutely.
I think that's a major factor here. Also, with the real economy in Japan, the way the real economy in Japan is set up, the way the Japanese economy prospers is because they do not have a lot of commodity, natural resources or commodities production in their own country. So they don't have oil and gas drilling and oil and gas wells. They do import a ton of their energy. Their nuclear power plants post Fukushima, I think that was 2011, have been offline for a very long time too. So they were importing for years because of the US, a lot of cheaper liquefied natural gas, while The shale bubble was happening and natural gas prices were falling. Obviously, LNG prices were more expensive, but still, Japan was one of the growth markets for liquefied natural gas exports because they didn't have their nuclear power plants online. But the Japanese economy is set up. They have to have cheap commodity prices. They have to have the US consumer with discretionary income. So in a stagflation environment where there's supply side problems for a lot of these commodities, especially energy prices, base metal prices over the last couple of years are up enormously. Japanese manufacturers, so your Sony making PlayStations, your Japanese car manufacturers, their input costs are going to go up. Now, if the consumer here in the US is not buying these things, they have less discretionary income because they have to spend more of their budget on food, rent, mortgage payments, electricity bills, gasoline, diesel, all these main staple things. They don't have the discretionary income to go out and buy Sony PlayStations, to go out and buy new cars.
Definitely not.
So the Japanese economy, the Japanese manufacturers, normally when they have cheap commodity prices, those are good profit margins because their raw materials costs or their inputs, they're importing all these inputs, raw materials, and those costs were low. So their profit margins would be good because then they're taking the cheaper raw materials and then they're turning them into value-added manufactured products, and then they're selling them, exporting them for high prices, and that's what builds a trade surplus. And then that's what allows Japan to build large foreign exchange reserves because trade surpluses are accumulated foreign exchange reserves over time. And then Japan was buying, instead of gold, Lee, which in my opinion, the Bank of Japan, Japan's central bank, and I don't know if, did you have a chance to watch the Prince of Yen's documentary? Excuse me.
I did. I watched the whole thing this week.
So if Japan wasn't being bullied by the US post World War II with a lot of their policies, financial policies, and then buying US treasuries in exchange for military protection, they would have been hedging their trade surpluses and foreign exchange reserves. They would have been at least partially with some of that accumulating physical gold in tonnage, but instead they bought a ton of US treasuries. I don't know the exact numbers in front of me right now. I don't have the numbers, but as of the last couple of months ago, Japan was the largest holder of any foreign government of US treasuries. I think it was well over $1 trillion. And when the Fed is hiking interest rates, Lee, that existing pile of US treasury debt that Japan owns, that's being devalued too.
I was going to say it's losing value very, very rapidly.
Yeah.
I actually had read that they had reduced their purchasing of US treasuries, but they're sitting on so much.
Well, if they're not, so they have to reduce their purchasing because if they're not running trade surpluses, you don't have you don't have all that extra savings. You don't have the extra profits because you consider trade surpluses basically profits. And then you have to park your profits, your free cash flow, you have to park it in something. And if you're a government or a central bank, you don't have a lot of options of things that you can buy because you're too big. So the US Treasury market was considered the most liquid, the largest and most liquid. Smarter governments, though, were diversifying their reserves and buying physical gold in tonnage. And unfortunately, Japan has not done that in a very, very long time. Maybe they will in the near future. If they actually announced that they were going to start accumulating physical gold tonnage, that might help their currency. Although I think there's going to be like a short covering rally soon and things may stabilize a little bit in the near future. But it just took many, many years longer for this trade to play out because because of their pile of treasuries is getting devalued if the Fed continues to hike interest rates. And then also their economy is not running the way it was designed to be run with cheap commodity prices and then exporting these value-added finished goods to the U.S. consumer and selling them at a nice profit.
Well, I think we should wrap it up on that note. It's been a really interesting discussion. I think we're set for a counter trend rally over the next couple of weeks in a couple of markets, but I think everyone has to take a look at the bigger picture, the global economic framework in which to invest in.
The dollar index did get above 104, so that is somewhat worrisome. And you did want me to quickly address why the Bank of Japan didn't get busted. So I'll just add a couple for a minute or two here before we wrap things up. The Federal Reserve Bank, there was disclosures about this. There was a speech by a New York Federal Reserve Bank president. It was covered in an article by the Gold Antitrust Action Committee in the last 3 or 4 years. My friend sent me the article. There was either a conference or a party, and a New York Fed president, a vice president, one of the higher ups spoke at it, and he admitted in the speech, because the central bankers, they do tons of crazy shit nowadays. They do tons of crazy shit. They're not even hiding it anymore. For the most part, they're not even really hiding it, because the mainstream financial media is going to cover it up for them. Wall Street, the large Wall Street investment banks they're getting bailouts from the Fed. And
they play along. They're part of the game. I mean, and basically what I've observed is everything they do messes something up, and then they just come back and try something else that fixes it for a short period of time, and then it gets worse and worse.
And that's because profits are privatized and losses are socialized. So losses are bailed out.
Yes.
Bad behavior is not punished.
Huge moral risk.
Bad behaviors, and things are more fragile, because they're encouraging leverage. They're encouraging gambling and speculation. They're encouraging Archegos to borrow $30 billion from Credit Suisse and go out and put on leverage trades on stocks, currencies, bonds. And then when both of them blow up, if the investment bank gives out these loans to all these different family offices and hedge funds, the hedge funds get bailed out, and the investment bank doesn't have to disclose all the truth about all the losses, and then they're secretly bailed out. And this brings me back to all these central banks that with the G7, this speech that was given in the last 3 or 4 years, a New York Fed higher up admitted that they have signed contractual agreements for emergency US dollar currency swap lines with the Bank of Japan, with the Bank of England, with the European Central Bank. I think there's a couple other major central banks in there that if the central bank gets in trouble now, and I think these currency swap agreements have been in place for a while. I'm not sure if they were in place when George Soros busted the Bank of England many, many decades ago, but now they're in place. We're to the point that there's all these secret bailouts going on, and the Fed's not putting them on their balance sheet. So all these short-term, they're called short-term loans. The Fed says they're emergency liquidity loans or emergency short-term loans. There's collateral, they're paid back. The truth is that they're not. The truth is that the Fed can move them off balance sheet. The truth is the Fed can just waive the loans. They've been doing this post-2008 a lot with the European Central Bank bailing out large European banks. They did this in 2019 and 2020. And that's probably why the Bank of Japan did not fail.
Probably the case. It's amazing what the Fed gets away with. It's just one big black box, and they seem to be behind everything. But on that note, it's been great talking to you.
And it will continually until the dollar loses world reserve currency and the U.S. military is not feared. So as long as we're on a global dollar standard, the dollar is used for the majority of cross-border trade settlements and global trade by large corporations. As long as that the normal status quo like that continues, this will continue.
Yep, I agree. Well, have a great weekend, Jason. I think it was a great discussion, and I'm sure some interesting things will happen between now and the next time we speak.
Yes, and one more thing. We really want to thank Jeremy and his wife, who's a listener to the show.
Absolutely. Yep.
Yeah, he produced a great logo for Finance Unspun. We tested one of the logos, I think, about a week ago. We got some good feedback. There were some trolls, obviously, but we did get some really good feedback, and we did implement that into the new logo design, and hopefully you guys like it. That's in the background for this video. So thank you very much to Jeremy for putting in the work there as a graphic designer, him and his wife, and hopefully you like the new Finance Unspun logo.
Thank you, Jeremy. Thank you, Jason. We'll speak to you soon. Have a great weekend.
Yep, and that's a wrap. So thank you for listening to episode number 4 for Finance Unspun.